thing I want to say on here as people are going to listen and so forth is I need for individuals to also understand that when you hop from accountant to accountant, from prepare to prepare, that's the kind of information that gets lost in translation. Because if you don't know that you did not get that deduction and you're going to somebody else and you don't give that new person your entire tax background, you're like a portfolio or a full copy of the prior year tax return that has all the information, those are the things that are going to get missed, because the loss carryover is a whole nother section in the tax return. It has a couple of pages. So if you just give the preparer the first 4 or 5 pages of the tax return, you may have missed out on additional information that the new person really needs to know about your file.
Taxes. And what's really important about to this to me is because I honestly, more than anything, hate taxes. Like I love talking about it because it's like any way that can save me more money, I'm all about it. And this is you pronounce your name Nany Gonzalez or
Nany.
Nany
Nany.
Gonzalez.
Nany.
Okay. Well,
Nany.
thanks for agreeing to come on here with us.
Sure.
Can you just tell us kind of how you got into taxes and everything like that? Like what inspired you to get into taxes?
Sure. So we're going to make a very long story short, because I've been in this profession since I was 19 years old.
Oh wow.
And my birthday's a couple of months off. And the dilemma that I have of how this all really happened was I have a knack for software. I have a knack for learning things pretty quickly. And so when I was working for a small firm of 2 ladies, I then went to the bigger firm, then went into private, then came back into the public arena. I just enjoyed educating, to be really, really honest with you. I just enjoyed educating. I enjoyed helping individuals. Before I opened my practice, which today, MOR Consulting Services is 9 years. Today is our anniversary. I always,
Congratulations.
thanks. I always did it as like a side hustle. I had a full-time job and then I had a side hustle of helping people with their businesses, helping people with whether it was taxes, the consulting, whether or not they're ready for investing, things of that nature. It's how it kind of evolved. So eventually, when I opened up my own practice or business, I really wanted to not just focus on tax, but focus on the full spectrum of business. Tax is a part of life. And so we just have to strategize year over year.
Don't remind me.
I like that. I like that.
Oh, I hate that it's actually part of life.
Yeah.
Anyways,
Hey,
so
then we're going to pay the piper.
is this actually? I guess this is not really. Is this something you really planned on seeing yourself doing, or like?
You know, as a child, you have your what you want to be, right? So as a child, I wanted to be an educator till I find out how much they got paid. Then I wanted to be an attorney, but I didn't want to do the 7 years. I didn't want to do the 7 years of college. And so business interaction with individuals was just a thing for me. So I ended up just working as an admin, moved my way up again. Then the accounting piece came into play. And then I worked for a gentleman a total of 14 years. And under him, I learned so much. Like he would let me learn any and everything I wanted, which is what I bring to the table when I meet individuals. And so I guess you can say yes, because I get a little bit of both worlds. I get to stay in the know dealing with law. I get to educate my clients. And then I get to do what I love to do every day. And that is, how can I help businesses grow? How can I keep them in compliance and go from there?
So I've read a couple of tax books myself, just because I hate taxes so much. Um, so what are some what are some of the advantages to buying real estate? Because all the tax books that I've read have always said there's so many advantages when it comes to buying real estate. Can you like shed some light on that?
Of course, of course. So like any portfolio, you have to have diversification. One of the biggest things that I have to tell individuals, you can't have all your eggs in one basket. You have to, when you are looking forward, when you're trying to expand, when you're trying to grow, you need to say, what is my exit strategy? Whether it's going to be in 10 years, 15 years, 30 years, and what is that strategy made of? Is it going to be a little bit of 401k? Is it going to be IRAs? Are you going to get into the stock market? Real estate plays a goal, because for most of the time, property appreciates, unlike when you buy a car that depreciates the moment you drive it off the lot. There is lots of benefits to adding that to your portfolio. Okay, so when you're working with your retirement person or you're thinking grand scheme of things, you say, okay, if I buy a piece of property, am I holding it for the longevity? Am I buying the property to live in it and then sell it? What is the purpose of the property? I myself said that by the time I turned 50, I wanted 5 properties, thinking small. I don't have 5, I have 3. That doesn't mean that in the next 2 years I can't get the other 2. But the point is that it was part of the bigger picture. Pros of owning real estate is that it helps you with what the plan is as you move into retirement. If they have a lot of equity and you need to borrow against it because you have another project going on, if your family starts to grow and maybe one of your individual children is going to move in and rent the property or live in the property, what is the grand scheme of things? The downfall for real estate is if you do rent it, the upkeep and the rental side of it. What happens if you buy a piece of property and like I did when I bought one in 2007, 8-ish, when all the market was really high in value, and then 3 years later, I'm $40,000 upside down in my property. But because my mindset was not short term, my mindset was longevity. Like I was holding on to this piece of property till either my children decided yay or nay they wanted to live in it, or I sell it down the road, which by then the goal is to have the property paid off. So that means all of the money becomes liquid into the grand scheme of things. So the pros of real estate is what is the purpose? What is the vision? Why are you wanting to buy this piece of property? The con is, can you afford to buy that piece of property? Can you make the mortgage payment if there isn't a renter in there? Is if the property is a property that was built in the 70s and it needs repairs, or are you buying a newer property? So I can give you a play for either direction. A lot of times that's one of the assessments we like to do when we're meeting with somebody is like, okay, you want to invest money in this. Why? What is the game plan? Where are you headed with that?
Okay. So it's more or less just make sure you have a plan and your plan matches your long term goals.
That is correct. I mean, why would I want to acquire properties? I mean, if I was I mean, I have property management and my individual owners, I have a handful that if they don't get the payment by the 5th, we're good. And then I have a handful that if they don't get the mortgage payment by the 10th, they're stressing because they can't make the mortgage.
Yeah.
Two totally different dynamics. They needed to have sat with a professional before they got into it.
Yeah.
Yeah, they don't really understand the cost. Because I have to tell a few of my owners, at the end of the day, it's still your house. You know,
Correct.
it's so sometimes they forget that they want the tenants to do it. Well, why can't the tenants do that? Well, they don't usually do those type of things. And
Exactly.
it can get expensive.
They do, and not to go down the rabbit hole of property management, but at the end of the day, whether you're self-managing, you need to make sure you understand the fair housing, what's your responsibility, what's not your responsibility, and then if you're using a management company, you want to make sure the management company clearly understands who they're allowing in your home, what are their best practices, what are they allowing, not allowing. So it's just having, again, strategy. It's all about
And
strategy.
now, but you can write off your management, right? I just so
Oh,
everybody knows.
of
Okay.
course, of
Okay. So
course. So I am not an advocate for self-manage. I can go on record about that because a lot of times you don't have the time. I know because I manage properties and I self-manage when I first started. So you don't have the time necessarily. You may not know all the ins and outs of what is allowed, what's not allowed. You also get into, can I really qualify somebody? Do I have the ability to really make sure that I'm getting a qualified tenant? And then collecting rent. Am I going to want to knock on the door on the 5th of every month and get the rent? So I am a firm believer of using a management company as a buffer between myself and and the individual living in my home. All of those things are deductible. It opens up a whole nother sheet of deductions with property management. It's just a matter of, again, what is the goal? I'll go on record. I am not making profit off my rental property in Virginia Beach because of the upside down, right? But it's helping me long term tax wise.
Yeah.
So the strategy is very different than what the outcome is for some other individuals.
So let's take it. So for instance, let's say you weren't managing yourself. What are some of the write-offs that you would be able to do if you did have a property management company?
Oh, yeah, I mean, you even if you self-manage, you can still write them off. But you have obviously, if your house is mortgage, you have the mortgage interest, repair and maintenance. And I want to say that with a little caveat in there because certain things are not immediately deductible. You have to depreciate it over time. You can write off the property management fee that you get deducted 10%, 8%, whatever the case may be. If you had to pay a commission to bring in a new tenant, sometimes commissions are paid. Any startup costs, any kind of advertising associated. If I have a property like my property in Virginia Beach that I'm having to drive 35 minutes out, I could write off the mileage to go and check on my rental property. That's also deductible. Any utilities that I had to pay related to the property, anything with related to HOAs or subdivision fees, things of that nature. It is a Schedule E, IRS.gov, Schedule E. It gives you a nice, pretty sheet of all the different things that you can deduct. Major things like if you paint the entire house, you replace the roof, you do new carpeting. A couple of years back, I think it was like 2016, 17, and they really enforced it in 18. You have to capitalize it. You have to, spread it out over time. But there's a slew of things. Again, it's lots of benefits in renting and using a property management company just to make sure your property is taken care of.
One of the things you said that actually I didn't know at the very beginning was that you can only write off the interest to your mortgage, not the whole thing. And that was one
You
thing I didn't
ah
know when I first got
Oh
it.
yes, you don't know how many times when we're doing taxes, I'll get this little thing that says, "This is my total mortgage payments for the year." And I'm like, "Yeah, but how much was the interest?" And they're like, "Wait, I don't get to write
What?
off the whole thing?" And I'm like, "No, no, no. Only the interest portion is what deductible, not the principal portion." And they're always a little floored. And unfortunately, when individuals come to me when they've been doing their own taxes, they come to our organization, I will find these little odds and end mistakes that they've done.
Yeah.
And I always have to say to them, well, we're going to let it go because I'm not going to make you amend. But moving forward, this is what you should do.
Yeah.
Now, that brings me to one thing that is always left off, believe it or not, and that's the depreciation.
Yeah, exactly. That was my next question.
You get to depreciate your property. Now, not to go down another rabbit hole because it definitely opens up something else. But if you are depreciating your property, which is what you're saying is reducing the value of that particular property, I need for individuals to understand that the theory or the thought behind that is if I'm writing off $3,000 in depreciation, somewhere I am saving $3,000, okay, for major repairs for replacement of my property. It's just like when individuals buy a property, you're supposed to save, depending on the value of your home, 3 to 7% or more annually for major repairs. So that when it's time to do the HVAC unit or it's time to do the roof, you have the money set aside. The problem with that depreciation expense is that a lot of times individuals that file their own taxes, even though, and I'm not going to name the companies, have done really well with being able to do your own taxes online, that section is not clear. How much did you pay for your property? When did you start renting it? So you can take advantage of that deduction. And once the year goes by, it's lost. If you didn't take the deduction, you can't take it later. You got to take it when
Yeah.
it happens.
So let's say I buy a rental property, and I believe you can only depreciate the actual building itself, not the whole thing, right?
Correct. Yes,
So
that's
how do you go about finding like, oh, the building's this much, and I can write it off like 27 and a half years? Is that what it was?
It's 27 and a half years. So what you do is you go to the city assessor's office. Most cities have it online, and it'll tell you that the house may be $100,000, but that the land is 30 and that the building is 70. Now you may have said, well, that's okay, but the city says my house is worth 100, but I paid 150. I get that, but what you need to understand is 30,000 is 30% of the value. So you take 150 times 30%, that would be the value of the land, and then you can get the value of the building. But
Okay.
most city assessors' offices, you can go, if they're not online, there is a way to find out what is the value of the land over the value of the home.
And you take that amount divided by 27 and a half
That's
years, and
correct.
that's how many you can
Yep.
do every year.
That is correct. That is the flat amount you do every year. Now, for most people, most of the companies that don't do it manually, back when we did fill it out manually, as I give out my age here, we used to have to look up the table to get the amount. Most computer systems, as soon as you put in how much was the property, when did you buy it, when did you start using it as rental, and fill in the value of the home and the land, it'll automatically do the calculation for you. You don't have to worry about that.
But it really hurts when we sell those rental properties. So talk about that a little bit.
That was the other, so that's the flip side. And that was what I was trying to say a few minutes ago or explain. Just because I didn't take the depreciation, let's say I forgot to take that benefit, when I go to sell the property, it's as if I took it. It still takes, it decreases the value for the number of years that you've been renting your property. So if, let's say, to keep numbers really simple, so the house is $100,000 was the value, okay? And I'm going to get, let's say, $2,500, and I rented it for 5 years. So I deducted $25,000, right? So when I go to sell the house, so I paid 100,000, depreciated 25,000, which means per tax value, the house is worth $75,000. We all clear there?
Yeah.
Perfect. I sell the house for 200,000. 200,000 minus 75 means that I made a gain of $125,000.
And that's what you pay your capital gains on.
That is correct. You would pay the capital gains off the 125. However, there's always repairs that are done to get the house ready for market. So if you had the commission, if you had to pay for showings, if you had to replace the roof, if you had to do carpeting at the very end in order to put the house on the market. Right now, we have a property that's being sold, one of our rental properties, and they're probably going to have to sink $7,000 just to be able to put the property on the market. Well, we're in the middle of 2021, right? So there's no depreciation deduction yet. So when they're calculating, they have to keep all of these expenses. So at the end of the year, when they file their taxes, they'll deduct the $7,000 from whatever gains there were. So this is where you get into conversations about it.
So when you're preparing your rental property to sell, how many months back? Could I start 6 months out
To
getting that
start,
property ready? Or do I have, how, is there a time frame of what I can use to say as to help to sell the property? I mean,
no,
can I put the roof on and 4 months later when I sell it, still use that roof as an expense?
Um, I would just, you have to keep track of all of your receipts anyway. Okay. So at the end of the day, as a preparer, and you give me the information, my liability is up to the information that was presented to me and that I filed it in accordance as it should be. It is you, the taxpayer's responsibility to make sure you have a list and a copy of all the receipts that you are using to prepare your taxes. So right now we're on the 2nd of July, and let's say you came to me and you said, or you guys are selling a property over there, and they said, "Oh, I want to sell my house by September." Well, you could put it on the market now, and every little thing that those owners are having to do to get it ready for market, they should be tracking it under repair and maintenance expense. You with me? So
Okay.
that, so when it's time to close, they have a nice little list of everything that got paid in order to take it to market. When they present the information to their tax preparer, they're going to show the information from the rental company, right? The MSA, the management agreement, what did they get in commissions, what they collected for the 9 months or the 8 months in rent minus expenses, and then here is my list of expenses in order to sell, and the 1099-S, which is ultimately the closing document of what was the value, so that it can then calculate what is going to be the capital gains.
So how much is capital gains? I know it's based on how much you made, but is there like a certain like ones like You have a certain percentage once you hit
Well,
70 or one.
there is a table. There is brackets. And so like for example, if your income was somewhere in the $40,000 range or 80,000 for couples, it was 22. If you're in the 85 to 171, it's 24. You're talking about net income. So if you're looking at an income of over 200,000, it could be upwards of 35%. I always tell most of the clients that I work with, I tell them all 30% of whatever they get needs to be put into a savings account and they need to forget about it till tax time. And generally
Yeah.
that's worked really well. At the end of the day, a lot of them have had extra money because they're not making over $414,000 a year as a couple. Most
Goals.
individuals that are in that income range, if I tell them, well, your tax bill is 12 grand, they're like, okay, here you go. They're not stressing it. The middle range, the individual homes that make between the 80 and the 171 a year combined, those are the ones that I say 30% must save it, put it to the side. Forget you even have that money. I don't care what happens to your car. You can't, I don't want to have an issue later on when it's tax time and I tell you I need 12 grand. I want to make sure that everything is clear and on the same page.
So I have had some clients that were high income, doctors, things like that. They said rental properties didn't help them. Is there kind of a income where really a rental property wouldn't be a good tax write off for people?
That is correct. If you make over, and I don't think they change it, I would have to look, but if you made over $150,000 and all your
Yeah.
rental properties are showing losses, you can't deduct it. It's
Yeah.
called carry forward. It will continue to go forward until you have similar like income, and then one will wash the other. You don't
So,
lose it. You don't lose the loss. It just carries forward to another year.
okay. So
Now,
you
here's the
really kind of
caveat.
need to plan at that point. If this is you need to plan probably at a certain point, either to unload the rental properties and do
Right?
something else with it, or keep it as long term and live on it when you retire.
Correct. There we go to the very beginning of how we started the conversation.
Right.
What is the purpose of holding on to the properties? If the purpose of holding on to the properties is for you to use them to sell them down the road for cash and add that to your portfolio, great. If the long term is my grandson, my granddaughter may inherit it or pass it on to another family member, great. What is the purpose of the rental properties? Now, one thing I want to say on here as people are going to listen and so forth is I need for individuals to also understand that when you hop from accountant to accountant, from prepare to prepare, that's the kind of information that gets lost in translation.
Right.
Because if you don't know that you did not get that deduction and you're going to somebody else and you don't give that new person your entire tax background, like a portfolio or a full copy of the prior year tax return that has all the information, those are the things that are going to get missed, because the loss carryover is a whole nother section in the tax return. It has a couple of pages. So if you just give the preparer the first 4 or 5 pages of the tax return, you may have missed out on additional information that the new person really needs to know about your file.
Yeah, yeah, I didn't think about that. So the 150, is that single person or is that joint?
No, it does vary. It does vary. I just know that the most of the time, once we see the 150 on there, it's dealing with passive. It's considered passive income for I can look it up, but a passive income limitations. It is the most of the time, once the individual starts getting to the 150 range, you start to see where it starts reducing what it can write off. Now,
Yeah.
keep in mind, passive income is a variety of things. Passive income can be some investments along with the real estate. So one will wash the other. So you don't really feel it in effect. But if your doctors are solely seeing the rental income and it's not giving them any real benefit, it's because they don't have another source of income to write it off.
Right.
They're being limited because of their income.
So what if they did like, so technically that's how much they, if they, let's say for instance they make 160, they can put like 10,000 of that into like a 401k. When that lower their, how much they technically made?
That's correct. Yeah, I mean, I can make $150,000 a year on paper, that is my offer, right? That's how much my
Yeah.
salary is. But I could be maximizing my 401k. So my box number one on that W-2 says that I only made 80,000. That is what it's going to use as a calculator.
And then, like, if let's say I broke even on the rental property, but depreciation brought me to 5,000, I could that 5,000 could offset some of your.
Net
Um,
income. That's correct. It lowers your what is called AGI. Yes.
I got
Yeah, it
It will
reminds me
lower your
all the time.
AGI.
What's the percentage that you can put into your tax sheltered
I
401?
tell everybody 30%.
That's because that's the
At a
max bill right
minimum,
now.
capital gains, I tell everybody 30%. It just makes it easier for me to have this conversation. It's just like when I'm talking to, and not to go down there yet, it's just like when I'm talking to a sole proprietor and they're saying to me, well, Nany, how much should I save in taxes for each? I say, well, when you close a month, 30%. And they always say 30%, that's a lot of money. And so when I explain them to them how that 30% is calculated, then they understand it. But it's 30%.
Hmm.
I know everybody's going, what?
But we live without it all the time, because if you were to take your paycheck and you were to look at the federal, state, Social Security, Medicaid, and do the calculation, average 10 for federal, average 5 for state, that's already 15, right? Then you have 7.65% between Medicaid and state. That's already 23%. There, you're so close to it. We just don't visualize it. Because why? Because we've learned to live off the net. When we start getting the gross, that's when we start freaking out a bit.
Right.
Yeah. So I know right now, like when you sell a property, technically you can 1031 exchange. I know Biden's trying to get rid of that and everything, but right now, what's the advantages of using a 1031 exchange right now?
Well, the advantage of the 1031 exchange, and people need to understand that there are limitations. You are buying of like value. There is a time limit in order to do so, but what you're trying to do is just pass off the gains of what may have occurred. Because why pay gains when essentially you're going to take, going back to the example, you're going to take that 125,000 and just basically buy another piece of property. It's kind of crazy to pay taxes on this money when I'm turning right around and investing it into something else. So the 1031 exchange is beneficial when you are wanting to continue, but let's say that this house that you've been renting is creating too much havoc, is all repairs have to keep getting done to it. It's just not in a neighborhood I want to deal with anymore. I can come up with 50 excuses as to why you want to let go of the property, but you don't want to lose out on rentals, so you want to go to something else. So you want to just make sure that they're similar, you want to make sure they're happening in the same year. That's the other thing.
It's
A lot
like
of
a
times,
45-day identification period, isn't it?
yes, but if you close in December, for tax purposes, guess what? Unless you're
Oh yeah,
immediately also buying, then
yeah.
you're going to get that 1099, you're going to get the 1099S, and you're not going to have the information to do the exchange to bring in the other asset. So basically what you're doing is exchanging one asset for another asset, and you do have a short window in which to do that. And you should let your brokers and the individuals that you're working with, that the purpose of this is to do the 1031 exchange so they can help you. Just now I work with a client that moved from Tennessee here, bought her home, husband got transferred here, and she's a real estate agent and completely forgot about the 1031 exchange,
Oh, dang.
sold there, bought here. And so I was trying to see if there was a possibility to rework the paperwork or something to try to minimize her tax exposure. So there's benefits in doing the 1031 exchange, but just keep in mind, all you're doing is you're kind of pushing it down the road. The disadvantages is the time frame. The disadvantages sometimes people is the documentation, keeping it into the similarity. And last but not least, gains doesn't go away. I want to make sure we understand this. It just gets pushed down.
Right. So when you say that 1031 tax exchange, that is just for investment properties, or can you do that on a personal property?
For right now, all I've ever seen it really is for investment properties. I have not seen them use it in the large dollar, like heavy equipment and things of that nature. No, no, not
And
for
does that
not.
have to be commercial to commercial, land to land, rental to
That's
rental?
correct.
Or
That is correct.
so you
Residential home to residential home, commercial property, land for land. That is correct. It's all in real estate. Everything dealing in real estate at this time.
So I cannot sell a duplex and then buy some land with it.
That is no, because that is not
That
is
kind
not similar asset.
So you can't sell 3 single family homes because you can do 3 to 1. You can't do 3 single family homes into an apartment building.
No, they're not alike.
Oh.
They're not alike.
What about like reverse 1031 exchanges? Can't you do like, let's say you rented it for a certain amount of time to like, and then you buy it, you rent it for a little bit, and then you go live in it? Can't you live in it for 2 years after that, and then do the live in 2 years, sell it tax free?
that sounds a little too good to be true. Is that
I read a book
So
once that said something like that one time.
let's clarify. So I bought a building. I bought a home. I'm living in the home for 1 year. I bought it in 2020. In 2021, I decided to rent it for 2 years. So for 21 and 22, the home is rented. I have added it. I have depreciated it for 2 years. Depreciation's gone on for 2 years. Now, year 4 of the property, so 20, 21, 22, 23, you're saying you're going to go back and live in the property for 2 more years, which now means 5 years. Well, guess what? When you're wanting to say, well, I'm back in this property, you have to, in the tax return, say that you dispose of that rental asset, and you have to then put in the calculator value of what that asset is. What is the current value? What is the asset? Now, in this case, a lot of times they'll put whatever the current value is what they'll put as value and move on, but you got to live in the property again for 2 years. You can't just say year 1, year 2, and call it a day. There's no tax benefit in that, in doing that. I'm gonna tell you right now. I have not seen a situation where there is a tax benefit for you. If that's what we're looking for.
what is that rule then? It's you have to. I bought a house. I lived there for 3 years and rented out for 2, and then sold it. I can avoid capital gains. Correct?
No, ma'am.
3 out of
No,
5
ma'am.
years.
No, ma'am. The only you have to live 2 out of 5. It has to be your property. If you ever convert that property to rental, you're now going to deal with it as capital gains because you converted it into an income earning asset. Now, whether or not you made money at the end of the day is a different story. But you've taken a property that you live in and converted it to income earning. So now when you go to sell it after renting it for 2 years, it is an asset. It is a Schedule C on your 1040 tax return as income earning.
So it doesn't help anybody in their taxes at all to
It just really depends. I have the 2 rental properties. So I have 3 right now, right? I mentioned I have 3. One, my parents live in it, so I can't deduct it because you cannot rent it to direct family, so it's not deductible. I don't record the income. I can't deduct the expenses. The other one, the Virginia Beach one, I take a loss every month, but that's okay because at the end it helps me in tax because you know what I mean. It helps me in the tax side. The third property, I do make money. I don't make a lot of money, but I do make money to kind of offset the losses from Virginia Beach. But that's the strategy. So that way, I'm not really feeling a loss. So it's not that it doesn't give you any benefit. It's just that what is the purpose of the rental property? Is it because you need money every month, or is it because you're looking at it as a long-term investment? What is the purpose?
Well, so why do they tell the military, like right now it's a big thing, like if the military rents their house, they get 10 years versus 5. So what is that 5-year rule? Does that make any sense?
10 out of 5 that they
Like the military get an extension on selling their property if they had to use it for rental, they get 10 years. Where we get that rule that says that if we live in there 3 out of or 2 out of the last 5.
Yeah. Well, that's because remember, when you sign up for the military, you have no control of them shipping you out and bringing you back. And then you go out again and then you come back. And we have individuals that are military. This is such a transient state. You know, we have so many military that come in. It's a way to kind of just help them understand buy property and know that we're going to give you some exceptions if they transfer you to Japan and then you come back instead of selling it, hold on to it as a rental property because you may end up coming back to Virginia and make that your home state retire in Virginia. So it's just an incentive to help them offset. But at the end of the day, when they go to sell the property, they're going to be subject to very similar rules as we are.
Dang, it's depressing. Because I know me,
Well,
I'm trying
I
to
mean,
find.
I love real estate. Believe me, I do. I love real estate. An understanding of what real estate's about. But and this is why I talk to some of the other brokerage homes, and I'm like, look, we really need to have conversations to truly understand, how buying a house is it really going to be beneficial. Now, I've had agents tell me that they will not send them to me first because they're afraid that I'll turn them away from buying a home. And I say to them, no, that's not what I will do. However, I want to make sure that they don't get into a home and then they're being foreclosed on. Or they
Yeah.
get into a home and then they get mad at me because they don't have the deductions that they thought they were going to have. When the rules changed in 18, well, they changed back in 15 and then they changed again in 18. All of those things kind of change and it has definitely affected. So just because you're buying a home is not going to automatically give you a bunch of deductions. And so that's the part that gets a little leery to me when I have to explain to them what were they really trying to say.
Right.
So it's
I,
more
I,
education.
See, I'm still confused about that rule, but that's probably my comprehended mind because it seems like we have been telling people that you can avoid capital gains tax if you don't rent it more than 3 years after you live in it, and that's not true.
so why do
Wow.
they say the 3 years? Why don't they just say like, oh, you can't do it? Period. Why would they say like the
Yeah, where did that come from? Where did that rule? It's like a fake rule.
It's not, I mean, I don't want to say necessarily that it's a fake rule. It just may be kind of like a deterrent. Like if you're in year 3 and you rent it, but then all of a sudden you realize that's not quite for you and you bring it back in, there's not going to be really something that affects you. That's year 3. If you're 2 out of 5 and you're saying year 3 you rent it, there's no real capital gains. You haven't deducted anything. The cost is minimal, but you're not going to tell me that in year 3 that you rent it and then you decide to sell it, you're not going to have $125,000 in capital gains. Well, I say that, but right now I know that homes are selling at a very high value. So people are going to have to deal with capital gains. Let's be realistic in the market we're in. So the capital gains is going to be an issue as people deal with that at the end of 2021.
Right.
So I kind of have like it's kind of like off topic of real estate, really. So how do so I'm very interested in like nonprofits. So how do like the taxes work for nonprofit? Do you know anything about
So taxes as in their 990 or taxes as in the real estate taxes that they don't have to pay
like
or
more like as like a business or a charity? So let's say I have this nonprofit and it doesn't make a profit technically, and you can give like a certain amount of it to charity. You can pay yourself like
okay.
a lot of salary. How does all that stuff?
So the theory behind it, okay, so the first thing I want to make sure we all understand, nonprofits have to make money. They have to make money in order to continue to moving forward. Unless the nonprofit is getting grants, is getting donations, is getting bequests of that nature, they have to make money in order to move forward. So if you qualify under the IRS guidelines for one of the nonprofit categories, because there's a variety of them, and you qualify under one of those qualifications, then you have to fill out a form that's called 990. All right, that is the tax form that is for nonprofit. That nonprofit has to say what the mission, vision, what is the benefit that they're bringing to the community, what is the need that they're fulfilling, so that it can file the tax return. And then you're going to say exactly what is the purpose of this nonprofit. So I use an example of one of the nonprofits that I sit on the board for. They specialize in transition housing. So when people come out of prison, they have to have an address in order to come out. They have to have somewhere to go. They come and they live in one of our homes for the time being as they get themselves established. They have to get a job. They have to pay money to back to the home like rent as they get established. So the nonprofit survives off of money being collected from the renters and donations that come from private individuals. Okay. of that money, if we have rent to pay because we're renting a house for them to live in, then the expenses are so forth. If we have a house manager and we've decided we're going to pay a stipend or a salary to the house manager, then out of the money we collected, we pay the salary to the house manager as a form of payment. Now, that house manager can also be one of the board members for the nonprofit. That part is not a problem. You can get paid a salary as long as you're sticking with the mission, meaning you can't have $100 comes in and $75 is going to your paycheck and you're only putting $25 into the mission of the nonprofit. That means you're out of kilter as to the purpose. Generally, rule of thumb is 35%. You
So,
have to keep your expenses low.
so how much do you have to actually give to charity or to the mission?
35%.
Percentage wise,
Yeah.
I always tell people rule of thumb is your overall expenses should not be over 35% annually. So for every $100 that comes in, $35 should go towards expenses, salaries, insurance, whatever needs to be done. And the other 65% should be going towards the mission of the nonprofit.
So technically, if like I'm like I don't know, I guess running for office, and technically $100 comes in, and technically I could pay myself $35.
You could. If you're set, if your office now, keep in mind, I'm going to go back. What was the setup of the nonprofit? What is the operating agreement? What does the operating agreement say? Does it say that it's going to pay the candidate a certain amount of money, or does it say, well, we're going to give the candidate, a $500 stipend a month to kind of cover a shortfall, and the rest is going to be used towards advertising, marketing, internet, bulletin boards, signs, things of that nature. What I'm saying is you can't get $100 in to support your campaign and then you turn around and pay yourself $100. That's funneling money. That's just
Yeah.
a way of hiding money. That's not a true nonprofit.
Yeah, and those to be accountable, that sound. I mean, I know there's a lot out there. It's kind of a trend right now. Start
I'm
a
sure.
nonprofit.
I'm
So,
sure.
I know the IRS probably monitors that, but is it really something that's kept an eye on?
It is because in that 990, once I put in how much money came in, if it was all donated, there's another section that anybody who donated over $5,000 has to be put on the list. So if I donated to your campaign $5,000, more consulting services gave you $5,000 for your campaign, I would be listed on there. And then the IRS could come and question the validity of me donating that money, or am I donating that money to you because I want you to sign off or I want you to sign in my favor. So I'm going to give you this money. We see and read about this all the time. So legally, there is a document that gets reported to kind of explain all of that. Is there somebody monitoring the monitor? I don't know. Usually it takes one whistleblower and then all of a sudden we find out all kinds of information. I don't think there's any one particular person that's saying, "Oh, let me go investigate more consulting's donation." But we know that any donations over $10,000 also have to be registered. I mean, that's a given that have to get registered.
So, what's the difference between a private nonprofit and a nonprofit? Are they the same thing?
A private nonprofit generally is something that's a little bit more enclosed. Generally, it's not grand scale things like the one that I'm a part of, TylerWynn Transition. That is a private nonprofit. We're not out there soliciting funds. Generally, nonprofits that tend to be soliciting funds from the state, from the government, from any and everybody tend to be a little bit more open. The good news is whether private or public, they're all listed at the IRS, and you can look at any tax filing online with the IRS.
So, a private nonprofit would be maybe some of these small churches.
They tend to be smaller organizations, a little bit more specialized kind of thing, not public open type of scenarios.
Huh.
Most political offices though are not private. Most political campaigns are not private because you have to disclose all campaign money.
Yeah, I was going to say, you think campaigns, sorry, would have to be public.
Correct.
Is there definitions, I guess,
They
somewhere?
are because there's several different types of nonprofits. So depending on the category you fall under is what they classify you. There's 501c3s, there are 501c6s. Do you specialize in an education environment? Do you specialize in community advocacy? Do you specialize in literary? I mean, there's several different nonprofit categories.
I guess my main reason that I asked is because you always see these politicians that they like run for office and all this, ask for all these donations and everything. I more or less just wanted to know how much of that are they allowed to pay themselves. That's why I
A
really.
lot of those politicians have money, so they don't pay themselves. They pay their campaign advisor, they pay maybe their media person, and a lot of those people are by contract. They may pay an admin, but as far as the actual candidate, a lot of times they're not paid. And if you ever want to know, you can go to irs.gov charities, find the name of the charity, look them up, and you can look at the filing, the 990 filing.
Oh, okay, well that's good to know.
Yeah,
I guess back to what you said about like I guess criminal people that get out of the prison, that
right,
y'all kind of help them transition.
right,
Y'all do the same kind of thing with like homelessness? Because I know my friend, she works at like a homeless shelter, and she said one of the big issues for a lot of people there, like there's people there, it could be for like drugs and alcohol abuse and stuff like that. But there's a lot of people there. It's like they just had a bad circumstance and they can't get a job because they don't live anywhere, and they
right.
can't get a house because they don't have a job. So they
Sure.
kind of need like a middle section to
An
like
address.
where to live. Yeah,
Yeah.
and so is
Our
that,
Yeah. Our particular program does not to say that they couldn't if somebody was to apply. We focus more on the people coming out of the prison, but there are programs out there that help. Unfortunately, in this area, you don't see as much as in the bigger cities. There's definitely a need for it. The
yeah. So that's
problem
what I was looking into.
the problem with a lot of those organizations is they have no funding. You
Yeah,
know, people that have been living on the street and really want to get off the street and really want to transition, you have to kind of see a need, a want, and a do. In the meantime, who pays their rent as they get started? Who covers
yeah,
their medical as they're getting started? Who covers? And that's where the need for private funding or private donations come into
yeah.
play.
'Cause that's what I was looking at. Because that's something I was very passionate about, like hearing that issue. Because you really want to make a change in the world. How do you really help people? And I feel like that's something that could truly help a lot of people. And I
Correct.
feel like the barrier to entry would be kind of difficult because you have to first have the real estate to do it and all that stuff. I just think that'd be
Correct. I agree. I agree.
Well,
Definitely.
before we wrap it up, just for something fun. So, has anybody ever come to you and just blatantly ask you to do something just really illegal, just to a point where you just kind of laugh and said,
All
let's
the time. All the
all the
time.
time.
All the
And
time.
do you just look at them straight faced or what?
and just be clear, it wasn't me.
Yeah. It's
No,
like,
we have individuals that, so prior to the tax change in 2018, prior to that change, somebody could give me their W-2s and I could look at them and do a quick count in my head and say, how many family members? How old are they? Okay, you're going to owe $4,000. And they would look at me and I would be within a couple of $100 because of working so long with the tax table. I could basically do the math in my head or scratch it out real quick. And at that point, they would say to me, "Oh, I'm not paying that." And I go, "Here you go." And I didn't have to go through the trouble of doing the tax return and then
Yeah,
you telling me that you don't accept it, which means you don't pay for my time or my services
yeah,
because you don't like the results. Even though by law I could charge you and you should pay me, let's be realistic, okay? We live in a world that if they don't like what they hear, they walk, right? So now with the new tax law, I'm almost there where I can kind of do the same thing, especially if they're kind of straightforward because now unless both parents have social security number, the EIC and earned income credits out the door. If they make over a certain amount, but one of them doesn't have this, the child credit is limited. So I'm almost to where I can do that as well, but you'd be surprised how no longer are they coming with these additional children that I know darn well are not their children, that they want to add to the tax return
come out to
that
the
they
van.
or they want to, and it's funny because it's not just Hispanics. Let me be very
Oh yeah,
transparent.
yeah,
It
everyone.
is not just, it is not just them. It is everyone across the board or want to tell me And this is where I don't know if we're going to have time for the LLC, but I want to touch bases. LLCs are important for protection, as far as separating yourself from your individuality. And the reason why I say that is always about liability. And I always try to explain to people, you don't want to lose the shirt you're wearing because you didn't have the legal protection. And that
Yeah.
is the biggest thing that I try to explain to individuals, even in real estate, protecting their individual properties, so forth and so on. But with an LLC, and we talk about the self employment tax, we're back to that 30% that I tell them to save between self employment and all the other taxes. I always say do the 30% to kind of go from there. And they get an understanding of that. The problem with LLCs is you have to make sure that one, they know about the tax, because that self-employment tax always catches them off guard. Second, they need to understand what is deductible, what is not deductible. And it's unfortunate, but I've had a couple of agents that have no longer done business with me because I won't write off their hair, or I won't write off their nails, or I won't write off their beauty spa when they're the face of the organization, type of scenario.
There
And I
should
try
be a
explaining,
difference.
and I try explaining to them, what is considered normal and what is not considered normal. And if you want to buy an Armani suit, okay, buy your Armani suit, but you better go and get it engraved. You better go and do some kind of logo on it, or do something to that Armani suit so that I can say that it's advertising and it's a uniform and it falls under the stipulations. So under the LLC guidelines, there is a little bit more, there's a little bit more flexibility on things you can deduct and not deduct. But I go back to, what is the goal? Is the goal to buy a house in a couple of years? If it's not, then let's deduct everything. And real estate agents, unfortunately, you guys are notorious. I hate to point you out, but you're notorious for leaving money on the table. I'll be like, okay, well, what about your licenses? Okay, well, what about your cell phone? Okay, well, I know that you sometimes have to pay room fees, like some of the brokerage houses around here. Some of them are deducted, some are not. There's always these different things. So you want to make sure that you have a true understanding of your business, what is deductible and what is not deductible. And it may not be deductible this year because we didn't talk about it, but once I educate you, you'll have it ready for the following year.
I always heard
Awesome.
preparation is key. Being
Yes.
It is.
organized.
It is. It is. Preparation is key. I try to explain, there's ways around everything. If you're really trying to validate a deduction, home office has been the biggest thing since for 2020, we all work from home, right?
Yeah.
So just making sure you understand what those rules are, and kind of go from there.
Got one thing. What is the craziest story that you've experienced in Texas? Like, has there been like a crazy story that kind of happened with from like a client or anything like that? I always
um,
like knowing people's crazy stories.
Crazy stories on the individual is bringing me a bunch of children that I know are not theirs.
Trying to get
That
that
is
similar
that
fun.
is one of the that was one of the biggest kickers. Now, as far as corporate, so let's talk a little bit about corporate stories. So corporate stories for me are when people are saying, oh, but my tax preparer prior said that I can write all of this off, my meals, my travel to Dubai, my so and so to such and such, because they did it all with the business company credit card. And I always try to explain to them that I understand, but unless you can validate it being a true business expense, that is a personal expense, not a business expense. Some of our crazy stories are getting people out of trouble and then they turn around and do the same thing again. It's like, you apparently love talking to the tax man, you know.
Yeah.
But as far as stories, I have more success. I Let me tell you a little bit about some of my success stories. Helping a single barber buy a house after so many years because we help them get compliant. How
There you go.
about a company growing to the point, with our help, that they were able to hire a CFO similar to myself to work for them. How about the individuals that were able to go from 3 fleets of cars to 20 fleet and triple their business in 2.5 years?
Yeah.
Those are more the things that I truly enjoy.
Yeah,
They
that's awesome.
hate they hate when
Empowerment.
they leave us. They hate when they leave us. They're like, Nany, I really reached a point. And I go, no, you graduated. Congratulations. You're ready to be on your own. Those are more the things that I truly enjoy being able to say. I understand transition's important. We have a niche small to mid-size. I have a couple of high-end clients that I work on, but we have a niche. We're in that small to mid-size, just kind of getting started. How do I keep myself legit? And how do I save on taxes? What do I have to do? That's our
Yeah.
niche.
So back to your one question. This is my last one. So for me to write off food, so do I just have to basically have the receipt, more or less say what we talked about, prove that it's business, like actually write
But
everything
you're
out?
only supposed to, you only can write off half because you have to eat. So you can write off the half that you paid to someone else,
No,
not the full amount.
I actually eat at my house. I just like pay for them. That's all. That's all I did.
Well, I'm going to tell you what I said a little while ago. You're the one responsible, not me. You got to be able to produce the receipt and who you had lunch with.
I got you. All right.
Yep.
Well, I learned a lot. Really
Yeah.
appreciate you coming on and talking to us.
Sure.
Yeah, and where can we find you? What? Tell us about what you do, real quick, and where they can find you.
Sure. Of course. So the company is MOR Consulting Services. It's a family. Mildred Omar Rodrigo is what MOR stands for. I go by Nany, but my first name is Mildred. We are located. I have two offices. One is in Newport News, 739 Thimble Shoals in the Oyster Point area, and the other one is in Hayes, Virginia, so just over the bridge. The Coleman Bridge is not too far. I have a website, www.morconsultingservices.com. On there, you can book an appointment with me. You can find out what myself and the team are about. I want to be very clear and transparent. It is not all me. We're a team of 8. We all work together, even though I'm the face. We all work together in getting things done. But I have a free consultation. So if they just want to run some ideas by me before they invest a bunch of money, I always say take advantage.
All right, thank you.
All right. Well, thank you again, by the way.
You're welcome.
Yeah, I'll make sure I prepare everything for you.
It wasn't too bad. It wasn't too bad.
Have a great weekend.
You as well. Bye bye.